Hey guys, my name is Rahul Shah and I welcome you once again to this YouTube channel where my goal is simple. It is to make investing accessible and profitable for the average investor. Now, my topic for today is, I would say, a little spicy because I'm going to be talking about penny stocks. Yes, you heard that right. Penny stocks. Now, penny stocks, I believe, are the deadliest double edged swords in the world of investing. If handled right, they can end up making a lot of money for you. But if not handled right, if you do it wrong, then you can even lose a lot of money in a quick time. So, on one hand, they can make you really rich in a short period of time. On the other hand, you could even end up losing your shirts if you're not careful while investing in penny stocks. And I think it is the second reason that scares most people away from penny stocks. They think that it is a risky endeavor and therefore should not be attempted at all, and therefore they try to stay away from penny stocks. But this is not how it should be. I believe that if you follow a sound intellectual framework, if you have a sound process of investing in penny stocks, you could maximize the returns from penny stocks and at the same time minimize your losses. So there does exist an investing method out there which I believe is uh, you know lucrative for you to invest in, and if handled right, it could lead to very good long-term gains in the stock market. And I'm going to be talking about exactly such a method. But before I do that, very important advice: no matter how much you try to reduce the risk in penny stocks, but the stocks by their very nature are risky, and therefore I would not advocate putting in a lot of money in penny stocks. If you have rupees 100 allocated to stocks in general, the allocation to penny stock should be to the extent of 5 to 10% only. You should not put more than 5 to 10% of your money in penny stocks now, no matter how attractive the opportunity. And this is something you should certainly keep in mind. So with that caveat, let's get into understanding what a good penny stock investing strategy is all about. Now, I'm going to start this so called crash course of investing in penny stocks with a very interesting anecdote or a very interesting story, if you will. My story goes back to the year 2003 2004. Uh, Back in 2003 2004, there was an American investor who was going through a list of Korean stocks. Yes, an American investor going through a list of Korean stocks. And this is very interesting because South Korea is 6,000 miles away from America, and yet this investor was interested in investing in Korean stocks. And within 5 to 6 hours, by going through the list of those stocks, he was able to zero in on 20 to 30 stocks that he found were attractive, and he went ahead and invested in those stocks. Now, I don't know for sure how he performed in those individual stocks, around the kind of returns that he got in those stocks, but the South Korean stock market was up 2 to 3 times over the next 3 to 4 years. So, if the South Korean stock market was up 2 to 3 times, there's a very strong chance that this guy would have made a killing in those stocks. And if you haven't guessed it by now, this the U.S. investor is none other than Warren Buffett. Yes, that's right. Warren Buffett was the American investor who, in merely 5 6 hours, was able to zero in on 20 to 30 good South Korean stocks and invest in them and make a killing. Now, try and understand the method that Warren Buffett followed. You know, he did not worry about whether he met the management, whether he knew that the company that he was investing in had sound growth prospects. He knew nothing about the industry. He knew very little about the business, and yet he went ahead and invested in South Korean stocks, 20 to 30 South Korean stocks, by doing nothing but going through the financial history of those companies just by doing some basic quantitative analysis. And this is the template that I would like to follow for penny stock investing. Now, a lot of people are under the impression that investing in penny stocks is all about, investing in the next sunrise industry, investing in, superlative managements, investing in companies which are, high growth in nature. But that's certainly not the case. Of course, these things may matter for some investors, but there's another way out there, the kind of strategy that Warren Buffett followed, which can also be used to invest in penny stocks. And I think it is the second strategy, the Warren Buffett kind of strategy, which I believe is more accessible to the average investor, because the average investor will not have access to the management of the company, he will not have access to a deep, detailed research on any particular industry, or he would not know the growth prospects of these penny stocks. Therefore, the Warren Buffett kind of method I think is perfectly suited for an investor who wants to invest in penny stocks and do well over the long term. Now, what is this Warren Buffett method? What is the kind of template that he followed, and what are the rules that he followed so that he could make a lot of money from South Korean stocks that we can incorporate into our strategy and do as well over the next 3 to 4 years. So let's go through these rules one by one. Now, rule number one. Now, for that, you have to take a look at this particular chart that is there on the screen right now. Now, it is the performance of the South Korean index between 1999 and 2007. Now, just focus on the time period that when Warren Buffett made investment in those stocks. He invested at the absolute bottom of those stocks. He made an investment in 2003 2004 where the South Korean index, benchmark index, had collapsed. He did not invest in the region to the left of the screen and to the right of the screen when the South Korean markets had topped. He invested in the towards the absolute bottom, and this is the most important rule of investing in penny stocks in my view. If you have any chance of making good money from penny stocks in the long run, you have to invest at the stock market bottom, because it is at the stock market bottom or when a bull market is just starting that penny stocks end up giving the maximum returns. So if you want to make good money from penny stocks, the bottom, stock market bottom, is where you need to have maximum exposure to penny stocks. And the biggest mistakes that people make is to not do this and invest at the top of the market. And top of the market, penny stocks are extremely risky, because when the markets fall from the top, penny stocks fall the hardest. And that is why when the market is at bottom, the exposure to penny stock should be the maximum, and when the market is at the top, the exposure to the penny stock should be minimum, or you should stay away from penny stocks. This is one of the most important lessons that you have to keep in mind. Now let's try and apply this particular scenario to the Indian stock market. Now this is the chart of the Sensex between December 2012 and December 2019. Now if you were to implement the principle that we learned in the previous chart, that is to invest at the stock market bottom, that point in this particular chart is the year 2016. As you can see in the chart, 2016 is where the stock market is bottoming, and that would have been a good time to invest in penny stocks if you have to invest in a stock market bottom. And a bad time to invest in penny stocks would have been the year 2018 and 2019, because that's when the Sensex seems to have topped out. So a good time to invest in penny stocks 2016-17, and a bad time to invest in penny stocks 2018 and 19. Of course, you should not take my word for it. You should rely on data, and that is what I have in the next chart. As you can see in this chart, 72% of penny stocks out of a total of 500 penny stocks that were available in December 2015, they actually went up over the next 2 years. And only 3 out of 10 penny stocks, they made a loss between December 2015 and December 2017. So this is a very important lesson that you need to remember, how when investing at a stock market bottom, you can get 7 out of your 10 investments in penny stocks right, and 3 out of 10 wrong. Now I have not defined a penny stock so far, so let me do it here. Penny stock according to me is a stock that is trading at rupees 50 or lower. Now a lot of different people have different definitions of penny stocks. Some people feel that penny stocks are those stocks which trade below rupees 1. Some feel that they are those stocks which trade below rupees 10. But according to me, penny stocks are stocks which trade at rupees 50 or below. And between December 15 and December 2017, at the stock market bottom, there were 500, close to 500 stocks which were trading at rupees 50 or below. And out of those stocks, 7 gave positive returns over the next 2 years, and only 3 out of 10 stocks gave negative returns. Now remember, the only criteria I have considered here is stock that is trading at rupees 50 or lower, or had a minimum revenue of rupees 100 crores back in December 2015. I have considered nothing else. I have not taken into account the financial history of the company, the growth prospects of the industry, the underlying management, and yet I was able to zero in on have a 70% strike rate. Why? Because I was investing at the bottom of the stock market. And this is a very important lesson that I think investors should note, that a very good time to invest in penny stocks is at the bottom of the stock market, and not when the stock market is at the top. What happens if you invest at the top of the market? Now as you saw in the earlier chart, 2017 was when the stock market had topped. So there were 300 penny stocks December 2017, and see how they have performed over the next 2 years. 93% of the penny stocks have lost money between December 2017 and December 2019, the top of the market, and only 7% of the penny stocks have made money between December 2017 and December 2019. And one of the biggest reasons this has happened is, again, because you've invested at a market top and not at a market bottom. So the number one rule, or the number one principle that all investors should keep in mind when investing in penny stocks is that you invest when the stock market has bottomed out, and you minimize your exposure when the stock market has topped. Now, how do you know that the stock market has bottomed out? It's pretty simple. The moment stock market falls 25 to 30% from its top, you should start investing in penny stocks. You should start taking exposure to penny stocks. And when the stock market has gone up 150 200% from the bottom, that is when you should start minimizing your exposure to penny stocks. Of course, there are nuances to this which I'll discuss in subsequent lectures, but it is a very important rule that you should keep in mind. Most people make the mistake of investing in penny stocks when the markets are at the top, and moving out of the stocks when the market at the bottom. But you should do the opposite. When the markets fall 25 to 30% or more, that is the time to invest in penny stocks and not move out of penny stocks. And when the markets have risen and are looking expensive from a valuation perspective, that is the time to unwind, to move out of penny stocks, to reduce exposure to penny stocks. If you follow this simple rule, this important rule, it will go a long way towards achieving good results from penny stocks. And most investors, they end up doing the opposite, which is something that you should not do. Now this brings me to a very critical question: is this a good time to invest in penny stocks? And I would say yes and no. Yes, because I think the market is still 19-20% away from its top, the peak that it reached earlier this year. But a very good time to invest in penny stocks would have been when the Sensex touched 26,000, when it fell to its lows because of the coronavirus pandemic, when people were shit scared of investing in stocks. That was the time to take a good exposure to penny stocks, when the index was 25-26,000 levels. It has risen a lot after that, but I think it's still a good distance away from its top. So it may not be as good a time to invest in penny stocks as, say, was the case when Sensex was 26,000, but still it's still not a bad time to invest in penny stocks as of right now. So this was my lesson number one in penny stock investing, that you should invest in penny stocks, take maximum exposure to penny stocks at the stock market bottom, and you should reduce exposure to penny stocks at the stock market top. As we saw, December 2016-17, 70-75% of penny stocks ended up giving positive returns. 2018-2019, 90% of the penny stocks failed. More than 90% failed. They ended up giving negative returns. So this goes to show that good money can be made from penny stocks if you invest at the bottom, and if you're investing at the top, there's a strong chance you will end up losing money in penny stocks. So that was my first lesson. I'll of course cover a lot of ground in the subsequent lectures. Which penny stocks to buy, what kind of penny stocks make the best investments, the number of penny stocks that you should have, when to sell them. All of this I'm going to cover in subsequent lectures, so keep watching. And before I leave, if you like this lecture, do not forget to press on the like button, and if you want to comment any further, there's always the comment section. So that is all from me as of now. Thank you so much, and see you in the next lecture. Thank you.